What's up, everybody? Welcome to another episode of the Bad Talk Show, man. So today we're going to talk about the stock market and if this is another bear market rally because the stock market's been going crazy. I know you're all seeing a lot of green, but should it be coming to an end? Is it coming to an end? We don't know, right? So we're going to cover all of that. We're going to paint a picture of the economy for you guys, let you know what's going on, and we're going to share all the links in the description below so y'all can follow along. But Rel, let's get into it, bro. What you got from him?
All right, so bro, listen, I know everybody's optimistic right now, like, yo, my stocks are rallying, it's back, but hold that thought. So first of all, something that we want to paint in the economy, we have to talk about GDP, all right? A lot of people don't know what GDP is, so I want to first preface it with ChatGPT explaining what GDP is for the audience. So it stands for gross domestic product, right? It is the total value of all goods and services, all right, produced in a country in a given period of time. Now, I said explain it in terms for a second grader because a lot of people are like, yo, I don't know. So just picture it like this. GDP is like a big money bag that shows how much stuff a country makes and sells over 1 year. The more stuff that the country makes and sells, the bigger the bag of money gets. And that means the country is doing well. So in other words, you want GDP to be positive, right? It shows growth in the country. Now, remember, in a growing economy, as you see in this line, it's in a growing economy, each quarterly GDP will be slightly bigger than the quarter before. That's a sign that more people are doing work and getting a little bit richer, right? So what is GDP looking like for this current economy? Well, we got the numbers for Q4. Q4's numbers was 2.9%. But in quarter three, it was 3.2%. So yes, it's growing, right? But it's actually slowing down. So we actually have a slowdown in GDP. From Q3, it was 3.2%, slowed down into Q4, only being 2.9%. So that's the first thing to bring up regarding the economy. Let's talk about something else. Newski, I know we got to talk about layoffs, spending.
Yep.
Talk to me, bro.
So the first thing is, right, well, I want to make a point real quick. So the GDP stuff that we just explained, notice that was done by ChatGPT. I just have to make that point real quick. Like the fact that we really have AI doing all this is pretty crazy. So that's just one point. So we know that's not doing too hot right now, right? We completely understand that. But another thing we have to talk about is this thing right here. It is the actual unemployment. So when you see this chart, it's right here in front of y'all, you see the unemployment rate right now is at 3.5%, right? For December. So basically we're going to find out for January and February. So it's always delayed. But when you look at this overall chart, notice how there's no crazy peak, right? That crazy peak that you saw is in 2020. But if you just look at it, it's staying pretty stagnant. It's nothing like 3.6, 3.5. Yeah, but the thing is, it started off at 4%. In 2022, which is why Jerome Powell was coming out and saying, yo, we have to start bringing the number down. It's not cool, et cetera, et cetera. And guess what happened? Bro, this number went down. Inflation was going up. He did his thing, right? Like he actually did exactly what he wanted to. He got inflation to come down and he got the unemployment rate to stay pretty stagnant. Now, the other part about it is this. The inflation in consumer spending deals directly with what we just talked about with the unemployment rate. Because as unemployment's going down or staying stagnant, I should say, consumer spending is declining, right? Because, yo, if people are getting fired, they're not spending as much, which clearly makes sense. So when you see over here, consumer spending declined or dropped 0.2%, pointing the economy was grinding to a halt. Now, when you think about it, so we have consumer spending going down. We have right here, it says inflation measures eased up a little bit. So inflation is doing pretty well. It's coming down. We have consumer spending going down. We have unemployment rate staying pretty stagnant right now. So it seems like the economy is actually getting back to track, which is exactly what Jerome Powell wanted when it comes to saying, yo, we want a soft landing, right? We don't want the plane to start coming down, just crashing and everything is blown up, because that would not be pretty. So whatever he said right now is actually looking pretty good when it comes down to it, correct?
Yeah, because at the end of the day, we want a soft landing because inflation is a major problem. We can't have that continue. Like you don't want inflation to be high if you're the leader of the Federal Reserve. That's horrible, right?
Mhm.
Now we're getting it down, but in order to get it down, you need to raise interest rates. When you raise interest rates, though, a lot of times that crashes the economy. A lot of times that sends us to a recession. A recession is usually coupled with unemployment being high and people can't spend and stuff. But it's like, nah, actually, he's bringing inflation down while unemployment is staying stagnant. So my boy is doing his thing, but hold that thought. You know what I mean? You're gonna see what happens. You're gonna see what happens next.
This is the other thing. Now, just think about this, right? We talked about unemployment, we talked about inflation, we talked about consumer spending, but let's think about this, right? So when we want to paint this picture of the economy, we have to see what companies, right, what institutions are thinking, what business leaders are thinking. So when you see this over here, it says 61%, and this is coming from 1,000 business owners. So it says right here, right, 1,000 business owners were basically surveyed to see what they think is going to happen. It says 61% of business leaders say their organizations will likely have layoffs in 2023.
It's a lot.
51%. 57% of business leaders who say layoffs are likely estimate at 30% or more of their workforce. That's not good, bro. This is not looking pretty. So we're seeing more layoffs happen. Now, when you think about it, bro, what does this mean for the economy, and what does this actually paint a picture of?
Well, this is showing that, yeah, unemployment has been good so far, but we're not out of the mud yet, bro. Like, these business leaders are saying they expect to be doing layoffs in 2023. And we told you here on Bag Talk, it takes a while for rate hikes to settle in. We did some very aggressive rate hikes in 2022. Like, historically, right? They had 4 75 basis point rate hikes. That's huge. That does not take effect immediately. It takes a while for that to trickle into the economy. So in 2023, as you can see, these business leaders are saying they will be doing layoffs going forward. It just hasn't happened yet. So the numbers look good right now. That don't mean they'll be looking good down the line.
That's a fact. And then the other thing that we want to paint a picture of when it comes to the economy is the whole inverted yield curve, right? So, Rel, talk about that real quick. Share your screen, bro.
Nah, I got you. So this is major, right? Because inverted yield curves tend to, predict what's coming next in the economy as far as whether it's going to be a recession or not. So right now, the curve is inverted between the 2-year and the 10-year. All right. So as you see here, it says that the inverted yield curve, this can be a sign of a coming recession. If the curve is inverted, that happens a year before all recessions since 1960, nearly all recessions since 1960. So if the curves are inverted, you can expect a recession to come in the following year. And for people who don't know what it means to be have a curve inverted, well, ChatGPT gave us a nice little way of putting it. If you were going to explain it to a second grader, they said, an inverted yield curve is like when you have a trampoline with one end higher than the other. Usually the trampoline is bouncier when it's higher at one end and flatter at the other. But when it's the other way around, that's not good. So in the same way, when interest rates for short-term loans are higher than the interest rates for long-term loans, that's like the trampoline being inverted, because that's not typical, right? Usually the long-term loans have a higher interest rate, right? But it's the opposite when it's inverted, okay? So that's a sign that the economy is not doing well, in other words.
And this is the picture that really helped me figure things out, right? So just think about it in a logical way, because sometimes, guys, we understand it can get confusing. But when Rel and I were talking about this, the reason why you want the long-term loan rates to be higher is because you want, right, the government wants it to be a period where, give us money, buy more bonds, so that way we have more money. Right? It's as simple as that. So they're going to make the interest rates better for long term, so that way they could actually hold money for longer. If the shorter one is better, that's not good, as Rel just explained. So that helps me when I think about stuff. The loan and the interest rate have to be better for the long term, because that's what the government wants. So that should help you guys paint a picture.
Yeah.
Now, go ahead.
I was just saying that when they're inverted for a certain period of time, it shows like, recession may be coming in the next year. Usually.
And I'm glad you said that's actually a perfect entry into this, right? Because this is exactly the last part of what we think is going to happen when it comes to the bear market, right? So we've been talking about this whole term of bear market rally, et cetera, et cetera. So I want to share my screen right now to explain to you guys what this actually looks like. So before we get into all this, right? This is a pretty cool article that I dug up. It's actually speaking about Deutsche Bank. So it's saying that a bear market rally in equity markets will continue into next year. Mind you, this came out in November 28th of 2022. And it says a German bank said that it expected the S&P 500 to rally to 4,500 in the first half of next year, which is this year. They're expecting it to come this year of 2023, and then it will fall back. So they're already talking about this, right? Banks are kind of like estimating this will all happen. This is the part that is actually pretty cool. So when we think about the bear market, and this website, shout out to them, the link will be in the description below. So it talks about what the bear market is. It says a bear market rally is a short-term upturn of 5 to 10% in a broader bear market downturn of between 10 to 20%. It signals a brief period of economic optimism, okay? And when you think about it, you're like, okay, it sounds pretty similar to what's going on, right? And this is a key takeaway. So it says a bear market short-term upturn of 5 to 10%, which we talked about. And it says it's a brief time period of where it could last between days and months, followed by continuation of declining prices, okay? So when you think about that, you're like, damn, that's not looking too pretty. This almost happens all the time. So examples of bear market happened in 1929, it happened in 2000 and 2001, it happened in 2020. And when you are looking at this, it's like, oh, okay, this is kind of crazy. But here's the thing that you have to understand. Bear markets are common occurrences with economic cycles. And every bear market between 1901 and 2015 has experienced a rally of 5% or more. So just think about that, guys. Like, this is not something that's new. It's been happening, okay? Now you understand what bear market rally means. Bro, can you actually show them all the numbers that we found out for what the stocks are doing, what the S&P 500 is doing, et cetera, because y'all need to understand what this really is looking like. And then we'll give you our opinion. But before we do that, please make sure you like this video because we're putting a lot of effort and research into finding and digging up all these links and sharing with you. So just like that, and it's absolutely free.
Yes, sir. You already know that. So, all right. So now look. The S&P 500 in the past month is up 5.8%.
And what was that number that I said earlier, bro? What was it between 5 to 10?
5 to 10.
Oh, isn't that crazy?
Come on now. Might be a bear market rally, but then again, who knows? Stay tuned. So look, let's talk about some common stocks, right? Nvidia in the past month, they're up almost 40% in the past month. Mm-hmm. Tesla in the past month is up 46%. Meta, Facebook, right? They're up 26% in the past month. How about some even like lower tier stocks that people don't talk about often? They've been going crazy, like BuzzFeed. They up 445% in the past month.
Like, this one's insane. When you told me about this one, it's wild.
I'm like, yo, what? It's wild. It's like, these are characteristics of a bear market rally typically. But then again, there's another stock that we talk about often, by the way. Gotta bring, I can't forget them, right? Block, Square, right? They're up 33% in the past month. The lovely block. But you know, like I said, this is not like atypical of a bear market rally where you're gonna see numbers like these. But there's always a time period you have to sit and say, hey, is this a bear market rally or is this actually the bull market coming back? Mm-hmm. Because at a point, it's not going to be a rally. And at a point, a person has to say, hey, is this the bull market? So I will let you answer that first. What do you think?
Yeah, so I would say this, right? I think that this is a bear market rally, in my opinion. I do see a lot of things in the economy doing better, which is good. But I think my biggest fear is this, that we haven't felt, and we talked about this on the channel before, we haven't felt the actual effect of the interest rates completely, I would say. I also think that we're going to see an increase in interest rates still, right? So I think that's another thing. So those are my concerns when it comes to the actual rally itself. And also just looking back in history, we have seen this before. I've spoken to people already where layoffs are happening in big sectors like finance and like tech, but also in small like mom and pop shops. Like I'm literally hearing people that I know getting laid off that work at regular shops, bro, regular restaurants. So all that's happening. And I think that's going to affect the market a little bit still. I don't think we're completely out yet. I think we still see a drawback. I don't see a drawback of 50% or something drastic, but I do see us coming back down and then stagnantly, regularly going up. So I see that happening.
Interesting. Okay. So I think that this is definitely a critical point, right? I'm kind of undecided, I would say, but I lean towards what you're saying, that this is a bear market rally. This week is huge coming up. Like, Wednesday we have the FOMC meeting where they're going to tell us their rate hike decision, which everyone is anticipating. And we showed you how to check this out on the CME Fed Watch tool, but everyone is anticipating right now that they're going to do a 25 basis point hike on Wednesday, which is expected. The market has priced that in already. Yes. I don't think they're going to shock anybody. But also, this is a big earnings week. This earnings quarter in general. And earnings is basically a company telling you their financial health. It's like getting a physical financially. Like, we're going to see their vitals. Every company reports earnings every quarter. This week is big for that. You got Apple reporting this week. I believe Amazon's reporting this week. Meta, right? And that's huge. So think about the names I said: Meta, Amazon, Microsoft already reported as well. Google as well has to report this week. And I'm bringing this up to show you guys. So look at this. Advertising growth has slowed, all right? And it has continued to slow. It's going to continue slowing. And this is big, okay? This is very big. The ad market slowdown has caused a slew of U.S. companies to implement drastic cost-cutting measures. So when it comes to ad spend, if companies are not spending as much as on ads, that shows a slowdown, all right? And if that happens, then their stocks are going to start selling off even more. Mm-hmm. So we want to see the numbers so far, because when it comes to the leading ad businesses, Google is the leader of that. They have the most market share of that. But that's followed by Meta and then Amazon as well. These are the three biggest places for ad spend. So their earnings this week are extremely important for us to look at, to see how the advertising businesses have been doing, as well as what they are projected to do for the rest of 2023. Because when a company reports earnings, they also report guidance. So they tell you, like, hey, we expect this coming forward over the upcoming quarters. Now, you saw that with Microsoft last week. Microsoft reported earnings, right? Remember, I was hyped. I hate you, like, Microsoft, they had great earnings, and then they stock plummeted because of the guidance. The guidance was bleak.
Mm-hmm. I was just about to say, like, I actually think that, and this is why I think it's going to happen. I think guidance is going to be weak again for these big companies, because, guys, like, just put yourself in their seats, right? Put yourself in the CEO for a second, and you would think, most likely, if I know people are fearing a recession and I know that it's not looking too hot, why would I sell my company high? Why would I say the guidance is going to be great? I would want to put the bar low, so if I exceed that bar, it looks good on my company. So if I'm doing that, that means I'm saying guidance is weak. Now, if I'm saying that, right, yes, you might think that all these institutions already know the game is being played, so they're not going to take that into consideration. But you have to keep in mind, these institutions are handling people's money, so they can't take that risk. Oh, maybe they're just bluffing. They can't take that risk, bro, because they have to report good returns. Because if they don't post good returns, it's over. So as soon as a big company says that guidance is weak, I don't care if you had good earnings. Most likely, I'm going to sell out of your stock. I'm going to rotate into a different stock, which means the price will fall. And then, obviously, since the price falls, the stock falls, and then the rally ends, right? So that's kind of what we want to kind of paint a picture for you guys. And we're not trying to be negative. It's just we do a lot of research when it comes to this stuff, so we're seeing it play out. The best way to avoid it, honestly, it talks about it in the link that we're going to post in the description. But continue to DCA, continue to invest in good companies that have good cash flow, that you're not gambling your money away, and you'll be good.
Yeah, I think honestly, this rally, I think it is a bear market rally. I said I lean towards that, but I never ruled out of my head that we've already seen the lows and that we could continue to push because if their guidance and their earnings are good, plus unemployment stays low while inflation continues to get lower and everything. I mean, what is the bear case for bringing the market back down? There is no bear case at that point. 100%. It looks like a soft landing is achieved. Companies' earnings are good. What more can you say? And so that's why this week is big. It will be something that can help us get a better decision. And maybe we'll revisit this topic on the channel. So make sure y'all stay subscribed. But stay tuned for this week. We just wanted to preface this so you guys understand how to interpret earnings, FOMC meeting, and you guys know exactly what to expect and not to get overly optimistic, but having a realistic viewpoint.
No, that's a great point. And also, guys, just to make just to make note of this, right? Just because we're saying it's a bear market rally, like we're leaning on that side, it doesn't mean that it's going to come crashing down and we're going to hit another low. Like just making that point clear for y'all. But hopefully you like this type of episode. Hopefully this paints a good picture for you guys of the economy and where we think things are going to go. Plus, definitely read up on the actual links that we're providing in the description so you guys are getting that knowledge in. But if you're still here, thank you. We appreciate you guys. And also, thank you for getting us more subscribers. Shout out to the winners of the giveaway. Y'all did it. Y'all did your thing, man. But congrats. So like always, please make sure you like, comment, and subscribe to the channel. Plus, hit that little notification bell because we drop
2 videos a week.
You don't want to miss them. Thank you. Make sure you check us out on Wednesday. But until then, peace.
Peace.
Soundstripe.